The government sent you too much money. Now it wants it back, and it will take your entire check to get it. You did not steal anything. You did not lie on any form. You did not even know you were being overpaid. The Social Security Administration quietly deposited more than you were entitled to, in some cases because of its own miscalculation. In some cases because a data processing delay meant your earnings change was not reflected in time. In some cases for reasons the agency itself cannot fully explain. And now, with no prior warning in any of the months the overpayments were made, a letter has arrived telling you that you owe the money back, and that SSA will begin withholding it from your monthly checks. Up to 50% starting in 30 days, whether or not you can pay your rent. Here is the part that should make you stop reading everything else and focus entirely on this chapter. The agency's own Inspector General found that 73,000 overpayments in a single year were due to problems with Social Security's own calculations rather than any fault of the beneficiary. SSA's automated systems could not compute benefit payments correctly in certain situations, and the agency did not provide employees with a comprehensive tool to manually calculate them. The government made the error. The government sent you the money. The government is now taking half your check until you pay it back. And the clock to stop that withholding started the moment the envelope was postmarked. The COLA that is not what it appears to be before going into the clawback mechanics. The 2026 benefit numbers deserve an honest accounting, because the headline figure and the reality in your bank account are two different things. Social Security benefits for 75 million Americans increased 2.8% in 2026. With the average retirement benefit rising by about $56 per month starting in January. This raises the average payment from approximately $2,008 in 2025 to about $2,064 in 2026. That $56 is the number SSA announced in October 2025. Here is the number SSA did not lead with. The standard Medicare Part B premium climbed to $202.9 per month in 2026, up $17.9, a 9.7% increase from $185 in 2025. Because Part B premiums are automatically deducted from monthly Social Security checks, about 1/3 of the entire COLA increase is immediately eroded by the Part B premium hike. The beneficiary who gained $56 loses $17.9 of it before the money ever reaches their account. The actual net gain is closer to $38. This is the third consecutive year that the Medicare Part B premium has risen faster than the Social Security COLA. The 2026 Part B increase of 9.7% is more than 3 times the 2.8% COLA. This is not a one-year anomaly. It is a structural pattern compounding silently each year, systematically eroding the real purchasing power of fixed-income retirees, while the headline COLA number generates positive news coverage. The annual Part B deductible for all Medicare enrollees in 2026 increased to $283, up $26 from the 2025 deductible of $257. For Chinese American beneficiaries who did not accumulate the full 40 quarters of Medicare covered employment, the costs go further. Those with fewer than 30 quarters of Medicare covered work pay the full part, a premium of $565 per month in 2026. Those with between 30 and 39 quarters pay a reduced rate of $311 per month. For immigrants who spent part of their working years in China or elsewhere outside the U.S. Medicare system, these are not hypothetical line items. They are monthly deductions that can consume a significant fraction of a modest retirement benefit before a single dollar reaches the beneficiary for living expenses. The new tax break hidden in the one big beautiful bill here is the counterpoint. The piece of genuinely good news that almost no one in the Chinese American community has been told about. Buried in the tax and spending legislation Congress passed in July 2025, known as the One Big Beautiful Bill, is a new deduction for people 65 and older that can reduce or fully offset the taxes they pay on Social Security income. The deduction reduces taxable income by up to $6,000 for eligible individual taxpayers, or $12,000 for eligible married couples filing jointly. Individual filers with a modified adjusted gross income up to $75,000, or married couples filing jointly with a combined magi up to $150,000 can claim the full deduction. Individuals with incomes up to $175,000 for single filers or $250,000 for married couples can claim a reduced amount. The deduction runs through the 2028 tax year for a Chinese American retired couple with modest combined income from Social Security and a small pension. This deduction may eliminate federal taxes on their benefits entirely. For a single retiree receiving just above $30,000 in combined Social Security and investment income, the $6,000 deduction could meaningfully reduce their tax bill for the next 3 years. The provision applies to the 2025 tax return filed in 2026. Discuss it with a tax professional before the filing deadline. There is also a Medicare premium angle. The 2026 ERMEA surcharge, the additional Medicare premium paid by higher earners, is based on the MAGI from your 2024 tax return. This 2-year lookback means that a high-income year in 2024, such as from a business sale, a real estate transaction, or a large retirement account distribution, is generating a higher Medicare premium in 2026, even if your income has since dropped significantly. If this describes your situation, you can file Form SSA -44 to request a reduction based on a life-changing event. Most people who qualify for this adjustment have never heard of the form. 13 months of policy whiplash, the timeline you need to understand the current overpayment rule. You need the timeline because the timeline reveals something important. This is not a stable policy environment. It is a political one. And political environments change. For most of Social Security's history, the default overpayment recovery rate was 100%. If SSA determined you had been overpaid and you did not respond or arrange alternatives, the agency could withhold your entire monthly benefit until the debt was recovered. In March 2024, the Biden administration reduced the default withholding rate to 10%. On the 25th of March 2024, SSA decreased the overpayment withholding rate from 100% to 10% or $10, whichever is greater, significantly reducing financial hardship on people with overpayments. That protection lasted exactly 1 year. As of the 27th of March 2025, SSA reinstated the 100% withholding rate. Reports emerged within weeks of seniors unable to pay for food, utilities, and rent. Some faced eviction. The backlash produced another reversal. For new overpayment notices sent on or after the 25th of April 2025, the 50% default withholding rate now applies to Title II benefits, which include retirement, survivors, and disability insurance. The withholding rate for SSI remains 10%. In 2026, these are the applicable rates by notice date. If you received an overpayment notice after the 24th of March 2024, but before the 27th of March 2025, SSA is withholding up to 10% of your monthly benefit. If you receive a notice dated the 25th of April 2025 or later, the default withholding rate is 50%. Overpayments for which notices were sent on or before the 24th of March. 2024 remains subject to 100% withholding if unresolved. If you received a notice before March 2024 and have not resolved it, you may still be subject to full withholding. This is not a theoretical risk. It is an active one for any beneficiary who received a notice years ago, assumed the issue had gone away because no further letters arrived, and has since discovered their benefit has been silently reduced or is about to be. The 3 clocks that determine everything when an overpayment notice arrives. 3 separate deadlines begin running simultaneously. Missing any one of them materially changes your options. These are the deadlines to memorize. The first is 10 days to keep receiving your benefit without any reduction while an appeal is pending. You must submit your request for reconsideration within 10 days of receiving the notice. SSA assumes you received the notice 5 days after the postmark date. A notice dated the 1st of January is assumed received by the 6th of January, making your reconsideration due by the 16th of January. If you file within 10 days, SSA cannot reduce your benefit at all until a final decision is made, 10 days from assumed receipt. Most people miss this window entirely because the letter sits on the table for a week while waiting for a family member to translate it, because no one explained that a 10-day clock starts from a presumed delivery date rather than the date you actually opened the envelope, and because most people have no idea that filing within 10 days is the only mechanism that completely freezes the withholding. The second is 30 days. If you ask for a waiver or appeal within 30 days of the notice date, SSA will not collect the money until it decides on your request. Filing within 30 days of the letter date pauses the entire collection process while your case is under review. This is the backup window if you miss 10 days. It does not guarantee your full benefit during review, but it stops the withholding clock completely while your case is pending. The third is 60 days. If SSA denies your reconsideration, you have 60 days to request a hearing before an administrative law judge. If you miss the 60-day deadline, you may still appeal if you can demonstrate good cause, such as a serious illness or a death in your family. Beyond 60 days without good cause, your options narrow significantly. You are no longer in the standard appeal process. You are making an argument to a system that is already skeptical. Write these 3 numbers on a card, 10 days, 30 days, 60 days, and attach it to your refrigerator alongside your attorney's phone number. When a Social Security envelope arrives, open it the same day it is delivered. Your 4 options: when the notice arrives, you have 4 legally available responses to an overpayment notice. They are not mutually exclusive. Understanding each one allows you to make the right choice for your specific situation. Option 1 is to contest the overpayment. If you do not agree that you have been overpaid, or if you believe the amount is incorrect, file Form SSA -561. Request for reconsideration. This is the right path when the underlying determination is factually wrong. Be specific. Do not simply state that you do not owe this. State exactly what SSA claims and attach documentation showing the correct figure. Use the evidence upload tool in your online My Social Security portal to submit PDFs directly to your case file rather than relying on postal mail given current processing delays. Option 2 is to request a waiver. If you agree the overpayment occurred but believe you should not have to repay it because you did not cause it and cannot afford to do so, file Form SSA -632, Request for Waiver of Overpayment Recovery. A granted waiver eliminates the debt entirely, not a payment plan, a full forgiveness. To qualify, you must establish 2 things: that you were not at fault, and that repayment would cause genuine financial hardship. SSA may find you were not at fault if you reasonably believed you had reported all required changes if you were not informed of the reporting requirement, or if you did not understand the requirement due to a language barrier or literacy issue. For Chinese American beneficiaries who received reporting requirements in English they could not fully comprehend. This last ground is directly applicable and must be stated explicitly in your submission. There is no time limit for filing a waiver request. You can file even after you have begun repaying the overpayment. Filing within 30 days still matters because it pauses collection during review. If your overpayment is $2,000 or less and you are not at fault, SSA can often resolve it through a simplified verbal process. A phone call to 1-800-772-12 the 13th of May be all that is required without the need to complete the full SSA -632 form. Option 3 is to negotiate a lower withholding rate. Even if you cannot establish non-fault and cannot qualify for a full waiver, you have the right to request a rate lower than the 50% default. Both SSI and SSDI recipients can request an affordable repayment arrangement by submitting Form SSA -634. Request for change in overpayment recovery rate. Many beneficiaries successfully negotiate a 10% cap, or as little as $10 per month, by presenting a monthly budget that shows ordinary living expenses consume all available income. The standard is financial hardship. If 50% withholding leaves you unable to cover rent, food, or medication, document those expenses specifically and submit Form SSA -634 alongside your waiver request. Option 4 is to do nothing, meaning you accept 50% withholding by default until the debt is recovered. This option is listed only for completeness. Failure to respond within 30 days results in automatic 50% withholding from monthly benefits. For beneficiaries no longer receiving benefits, SSA may collect through tax refund withholding, state payment offsets, or wage garnishment. There is no scenario in which inaction produces a better outcome than any of the 3 active options above. The 4 forms a reference card the barrier for many Chinese American families is not understanding the options conceptually. It is finding and submitting the correct paperwork in English under deadline pressure. Form SSA -561 is for disputing the existence or amount of the overpayment. File within 10 days to freeze all withholding, or within 60 days to preserve full appeal rights. Form SSA -632. BK is for requesting full forgiveness of the overpayment, based on non-fault and financial hardship. No strict deadline, but file within 30 days to pause collection. For amounts under $2,000, call 1-800-772-1213 first. A phone waiver may be available. Form SSA -634 is for requesting a lower monthly withholding rate than the 50% default. Use this when a full waiver is not available, but 50% withholding would cause genuine hardship. Form SSA -44 is for requesting a reduction in Medicare premium surcharges if your 2026 premium is based on a 2024 high-income year that no longer reflects your current income due to a major life event. All 4 forms are available at ssa.gov, submittable online through the My Social Security portal, or can be faxed to your local field office. For family members assisting an elderly beneficiary, Online submission is the fastest pathway if an account exists. If not, fax is more reliable than mail given current SSA processing backlogs. If you have not received a notice yet, act now. Proactive steps taken before an overpayment notice arrives are worth considerably more than reactive steps taken after one does. Set up a My Social Security online account at ssa.gov. Beneficiaries who created an account by the 19th of November 2025 can view their COLA notice online in early December, rather than waiting for mail. The account also gives you the fastest possible response pathway if a notice does arrive, and allows you to check your earnings record and benefit calculation for discrepancies before SSA identifies them first. Verify your earnings record. Any mismatch between what SSA shows and what your tax returns or pay stubs document is a potential overpayment trigger. Correcting it proactively before a notice generates is categorically easier than contesting an overpayment after the fact. If you are working while receiving benefits, confirm your 2026 earnings will not exceed the applicable limits. The earnings limit for workers younger than full retirement age in 2026 is $24,480, with $1 deducted in benefits for every $2 earned above that amount. The earnings limit for people reaching full retirement age in 2026 is $65,160, with $1 deducted for every $3 earned above that limit until the month full retirement age is reached. Exceeding either limit without reporting the change to SSA is among the most common causes of beneficiary-generated overpayments. Finally, if you are 65 or older and your income falls within the eligible range, confirm with a tax professional whether you qualify for the $6,000 senior deduction under the One Big Beautiful Bill before filing your 2025 return. It is among the most significant positive changes affecting Social Security taxation in years, and the majority of eligible Chinese American retirees have not yet been informed it exists.